The bank that bought the Caribbean, Republic Bank's expansion. Walk into any bank in Trinidad. Chances are, you're walking into Republic Bank. Go to Guyana, same logo. Barbados, same logo. Grenada, St. Lucia, Dominica. The blue and white Republic Bank sign is everywhere. From Port of Spain to Accra, Ghana. 23 territories. Over 100 branches. $10 billion in assets. This isn't a multinational giant like HSBC or Citibank. This is a Caribbean bank. Started on a tiny island of 1.4 million people. How did an island bank go from serving rum shop owners in Trinidad to dominating an entire region? This is the story of Republic Bank's ruthless expansion. The acquisitions, the controversies, the regulatory battles, and the billion-dollar question. Are they a regional champion or a financial predator? To understand Republic Bank, you have to go back to 1837. The Colonial Bank of Trinidad opened that year. British-owned, serving plantation owners and colonial administrators. This wasn't a bank for Trinidadians. It was a bank for the empire. Over the next century, the name changed. Colonial Bank became Barclays Bank. Still British, still serving colonial interests. Then 1980 hit. Trinidad was riding high on oil money. The government decided, why should British banks control our financial system? They forced a buyout. Barclays became Republic Bank. Trinidadian owned, Trinidadian managed. For 2 decades, Republic Bank was just another regional bank. They served Trinidad, maybe Tobago. They were comfortable, safe, boring. But then the 2000s arrived, and Republic Bank stopped being nice. A new leadership had a different vision. Why stop at Trinidad? The turning point came in 2008. Financial crisis. Global banks were retreating from the Caribbean. Too small, too risky, not worth it. Republic Bank saw blood in the water. First target, RBTT Financial Group, a major regional competitor operating across the Eastern Caribbean. Republic Bank paid $514 million, instantly doubled their footprint. Suddenly, they were in Barbados, St. Lucia, St. Vincent, Grenada. The Eastern Caribbean banking landscape changed overnight. Competition? Gone. Republic was now dominant. But they weren't done. 2013. They went after Scotiabank's operations in the Eastern Caribbean. Scotiabank was pulling out. Too expensive to maintain small island branches. Republic stepped in. They bought operations in Anguilla, Antigua, Dominica, Grenada, St. Kitts, St. Lucia, St. Vincent, and the British Virgin Islands. Cost, $123 million. Another 8 territories. Just like that, the blue and white logo replaced the red Scotiabank signs. Local governments celebrated. Local Caribbean ownership, they said. Better than Canadian banks abandoning the region. But local competitors weren't celebrating. They saw something different, a monopoly being built, acquisition by acquisition. In some islands, Republic Bank now controlled 40–50% of all deposits. In Trinidad, their home base, they controlled nearly 60%. That's when the regulatory battles started. Guyana, 2013. Republic Bank wanted to buy Scotiabank's Guyana operations. Standard deal. Should have been simple. The Bank of Guyana said no. Too much concentration. Republic would control too much of Guyana's banking system. Competition concerns. Systemic risk. Republic Bank pushed back hard. They lobbied. They hired expensive lawyers. They argued Guyana needed Caribbean ownership, not Canadian banks. The battle lasted months. Finally, regulators relented, with conditions. Strict limits on market share. Regular oversight. Republic got Guyana. But barely. Similar fights erupted in Barbados, in the British Virgin Islands, in Grenada. Every acquisition came with controversy. Local businesses complained about reduced competition. Other banks cried foul about predatory pricing. Republic's defense? We're Caribbean owned. We're reinvesting locally. We're not extracting profits to Toronto or London. It worked politically. Caribbean governments loved the narrative of regional ownership, even when it meant one bank controlling everything. But economists weren't convinced. Less competition means higher fees, lower interest rates on deposits, more power in fewer hands. The expansion continued anyway. By 2018, Republic Bank was too big to challenge. Too politically connected, too systemically important. And then they made their most controversial move yet. 2019, Republic Bank announced something shocking. They were entering Africa, Ghana specifically. They'd bought a 94% stake in Ghana's GHL Bank. The Caribbean banking world was stunned. Why Ghana? Why now? Why at all? Republic's explanation: Ghana is the gateway to West Africa, growing economy, young population, huge opportunity. The critics had different theories. Theory 1, the Caribbean market is saturated. They've bought everyone they can buy. They need new growth. Theory 2, this is ego. The CEO wanted to build something pan-African, legacy building, not business strategy. Theory 3, they're diversifying away from Caribbean risk, climate change, hurricane exposure, small island vulnerability. Whatever the reason, the Ghana bet was expensive. $80 million to acquire, millions more to rebrand and operate. And so far, it's not clear if it's working. Ghana's banking sector is crowded. Competition is fierce. Republic Bank Ghana is tiny compared to local giants. 5 years in, they're still trying to prove the Africa strategy makes sense. Meanwhile, back in the Caribbean, they keep expanding. 2022, they finalized the Scotiabank BVI acquisition that took 9 years to approve. The empire keeps growing, whether Ghana works or not. So what is Republic Bank really? Are they a predator? Critics point to the monopolistic control, the crushed competition, the higher fees in islands where they're dominant. Walk into a small Eastern Caribbean island, try to open a bank account. Often, Republic is your only choice. That's power. Unchecked power. Are they a champion? Supporters point to Caribbean ownership. When Royal Bank and Scotiabank abandoned the region, Republic stayed. They invested. They maintained branches in tiny islands that weren't profitable. Someone had to serve these markets. Why not a Caribbean bank? The truth is, probably both. Republic Bank filled a vacuum left by foreign banks retreating. That's good. Caribbean capital staying in the Caribbean. But they've also built something concerning: near monopoly control in multiple territories. When one bank controls that much of a nation's financial system, risk concentrates. Competition dies. Innovation stalls. The Ghanaian bet is the wild card. If it works, Republic Bank becomes genuinely international. A Caribbean success story conquering Africa. If it fails, it's a $100 million lesson in overreach. From Barclays' Colonial outpost to Caribbean banking giant. From serving Port of Spain to operating in Ghana. From British ownership to Trinidad's largest company. Republic Bank's story is the story of Caribbean ambition. The good and the complicated. They proved Caribbean companies could compete regionally, could buy out foreign banks, could dominate their space. But they also proved consolidation has consequences. Less competition, more control, more risk. Walk through any Eastern Caribbean town today. The blue and white logo is everywhere. On the bank, the ATM, the credit card in your wallet. That's either reassuring or terrifying, depending on whether you work for them or compete against them. One thing's certain, the bank that bought the Caribbean isn't done buying.